Hello and welcome. And we're here at Holistic Investments, and I'm your host, Konstantin Kogan. And I'm excited to have here two great co-founders at Fourth Revolution Capital, Keegan Selby and EJ Rogers. Hi, guys.
How you doing?
Amazing. It's actually my first interview with two people together, two co-founders. So it's exciting. We're going to do this experiment, and we're going to share some of the interesting ways how to increase your yield. We're going to talk about DeFi. You're going to share the screen even to show some of the intricate details how to get into the DeFi space. But before that, traditionally, we have to get off the hook and allow compliance officers to approve this episode. So this content is for informational purposes only. You should not construe any such information or other material as legal, tax, investment, financial, or any other advice. So we're off the hook. So let's talk a little bit about your background, guys. Like, how did you even get to crypto? Like, why did you start Fourth Revolution Capital?
Sure, I'll go there. So EJ and I met in college at USC. I was studying aerospace engineering and entrepreneurship. He was studying finance and econ. We ended up both working at the same asset manager and fund outside of college. After college. It was this $100 billion, real estate and finance mortgage credit manager with this huge vertical under it. So they did everything from brokerage, lending, servicing, title escrow, secondary capital markets, you name it. And we were in a management associate program there. So we went through, kind of all the core business lines, and then ended up in the Fintech startup arm, which was tasked with kind of creating this single digital destination for all the real retail-facing components of the company. So essentially one place where you can go to search for homes like Zillow, to get a loan like Rocket Mortgage, and then close and own and kind of pay your mortgage payment, pay your insurance, and aggregate a lot of your kind of home-related expenses in one dashboard. So while we were building kind of that piece of fintech, we were exposed to one, kind of how all the myriad inefficiencies and kind of rent seekers in traditional financial products and services and fintech. And two, we were really getting involved in crypto. We've been trading Bitcoin since early 2013. And then when Ethereum hit the scene and we kind of grasped the concept of if-then logic for programmable money, that was like, a big light bulb for us. We're like, wow, this is more than just kind of, store value gold, asset. This is something that could be entirely revolutionary for the financial system. And then when decentralized finance, some of the key apps really started gaining usage, we started to see billions of dollars locked in their smart contracts. We were like, hey, this is the time earlier this year that we should leave TradFi behind, and we should commit 100% to supporting the evolution of DeFi. So that's kind of our backgrounds, how we got involved in crypto, and why, we're so passionate about DeFi as a kind of specific sector. Maybe I'll pass off to EJ, who can talk about, how we started Fourth Revolution Capital, what our investment strategy, our thesis is, and kind of why we're so excited about, being involved in the space.
Yeah, thanks, Keegan. So, as just mentioned, I come from a traditional finance background, Keegan from engineering. We ended up in this, big real estate mortgage credit asset manager. And we had this unique experience where, we were working for what was effectively a fintech startup. So we had the fintech and consumer internet experience there, building that new technology, shipping product. But at the same time, we were actively operating legacy companies and legacy systems, and it was painfully obvious to us that these systems just were not going to be the future. And at the same time, as Keegan said, we were kind of, our personal interest in crypto and blockchain was taking up more of our excitement, more of our mind share. We came across this report in 2018 that was by SFIG, the Structured Finance Industry Group, that was specific to securitization in the mortgage space. So talking about how blockchain technology could be leveraged to improve and make more efficient every step, all the way from origination of a loan through servicing, through secondary market operations and securitization. And that was kind of a light bulb moment for us where we were just like, wow, this this future kind of utopia vision is A, attainable, and B, so much better than what we're seeing today. At the same time, we had this idea, within the company of this concept called home shares, where you could effectively, before this technology really even began to exist, but like somehow fractionalize ownership in your home and have a much more fluid liquidity profile. So to be able to basically very quickly, like you might in Aave today, take a quick loan against your house rather than having to go through the process of a traditional refinance or cash out or, a HELOC. So we started to think through, how could we apply these things to the company that we're at today? Since then, we've just continued to kind of percolate through ideas, different startup concepts within blockchain. And ultimately, DeFi kind of hit its stride right in time where we were saying, this is what we want to do professionally. And, we have started to see the real product market fit, the real usage, the real cash flows that create an opportunity to value some of these companies in ways that traditional investment methodologies can process and that traditional investors can understand. So that was kind of the impetus for launching 4RC. And our goal in the fund really is to partner with founders and with teams that are creating solutions via crypto that allow users to do the same things they do in TradFi, but in a more easy and accessible way. At the same time, kind of opening up markets to the unbanked and sort of all of this, the ethical upsides that you hear, the societal upsides that you hear associated with crypto. So, we kind of come into the scene really looking to partner with these teams, get our hands dirty when we find a project that we believe in. We really see ourselves as extensions of the founders and of the developers, and doing everything we can to kind of help leverage our experience operating traditional businesses to kind of guide and help support in whatever way we can. So whether that's token economic modeling or, DAO mechanism designs, just incentive structures, helping the teams kind of navigate the personnel side. Those are the types of things that we're really excited about. And, we're stage agnostic. We're flexible in what we can invest in. Right now, we're really focused on DeFi. And again, that's just sort of because that's where we see the first killer use case coming about in Ethereum. We're probably partial towards teams that have a token or plan to launch one right now. Not to say that that's a forever thing, but that's just, as of now, what we see as the best way to, through token economic modeling, align incentives and get all these different stakeholders that have their own kind of self-interests operating in ways that are beneficial to the protocol on the whole. So that's 4RC in a nutshell, I guess.
Yeah, no, this is helpful. And so let's go. I have already a lot of questions for you. So a little bit of background before we go into your investment thesis and of your due diligence process. So as I understood, from your pitch deck as well, like the fourth revolution capital, like as the idea behind it is like it's also to substantiate with some of the history, I would say. There are three industrial revolutions. The first one was, when we went through from the transform the agricultural, based villages into more factory based, then the second one was from, invention of electricity and the combustion engine. And the third one was computers, internet. And now we're talking about artificial intelligence, blockchains, and other great, innovative products. So now, in this fourth revolution, how do you even due diligence, so to speak, this Web3 projects? What is the main criteria for you guys, when you look at the protocol, right? So we see a lot of, DLT projects, and some of them are, deemed to be like those unicorns in the crypto aspect of this world, and some of them potentially won't go anywhere because the adoption is very slow and might not be even the case. So can you talk about a little bit of this aspect? What is your due diligence process?
Sure. So I think the first one, the easiest thing is, if this doesn't present a massive improvement over the TradFi status quo, then maybe we should prioritize elsewhere. So things like savings accounts at Chase. You have a 0.01% interest rate on your savings account at Chase. That's 1 basis point. That's $10 on every $100,000 you have in your savings account at the end of the year. In Aave, that rate on US dollar pegged stablecoins floats from anywhere from 2 to 5, 10 to 12%. So that's 500, that's 1,000 times, it's 3 orders of magnitude improvement, kind of in the best, at the top of the rate cycle, over TradFi. And
so for someone who's not familiar with Aave, sorry to interrupt you, but can you explain in a nutshell, what is Aave?
Yeah. So Aave is, in a nutshell, it's just a single platform to borrow and lend on. So it's a money market. So you can deposit assets like stablecoins. You can deposit assets that are volatile like Chainlink or Ethereum. And you can borrow against them, or you can simply earn interest on the assets that you deposit. And so there's that where there was like, hey, this is, if the yield is 5% on Aave and it's 0.01%, that's 500, times more interest that I'm making on my money. So that's a no-brainer. That's a product and platform that we would certainly be interested in investing in. And then 2, it's this brand new use case altogether where like borrowing against other volatile assets, that's kind of equivalent to infidelity if you ever to like deposit your Tesla stock and borrow Amazon stock. So now you have exposure to both those stocks, but you never had to buy the Amazon. You were able to borrow against your Tesla. And then, one, if you put it up in London, you're maybe earning interest on your Tesla, like an additional dividend. And 2, you have kind of the ability to gain margin or leverage and gaining exposure to other assets. So that was kind of like the mind-blowing light bulb moment where EJ and I were like, hey, we're beyond just, hey, you're earning more interest. We're into all brand new use cases enabled by DLT and smart contract technology that just simply aren't possible in the traditional finance space. So that's probably step 1 in our due diligence. Like, hey, does this thing really matter? Are these tokens, what are the value accrual mechanisms, or what are the profit centers that actually, that create price floors in situations where tokens should appreciate with usage? So kind of the token economic model would definitely be second. I'd say probably the path to decentralization. So is this project, does it have some central entity that has admin keys to inflate do some crazy inflationary monetary policy and print, mimic the Fed and print, billions, trillions more in value of the token, which could, cause inflation, cause the token price to depreciate? Or are they, pursuing a path to like DAO governance? Are they trying to hand over governance of the protocol and the platform and what assets can be listed as collateral, et cetera, all those decisions to the actual community, to the users that are using the product? So that to us is, from a regulatory risk perspective and from just, the ethos of DeFi, is another major kind of qualifying factor that we look to kind of evaluate with the founders and make sure that they don't want to be the supreme rulers forever, and they want to hand over kind of the keys to the car to the community and the users. So I think those would be my top 3. I don't know, EJ, if you have anything else to add.
Yeah, I think it kind of touches on the first point of is this thing useful? Like, what are users going to want it? Are they going to go through the added trouble, if we're being honest, as it is today, of learning about DeFi and actually interacting with protocols? And so another piece there, I think, is you kind of got to look at where do you see things going. We talk about like TradFi coming in and all this, the treasury narrative, all these people buying Bitcoin, institutions getting exposure, pensions, large family offices. And then you start to think, okay, well, what is going to be necessary for not maybe what the world doesn't look like today, but what it might look like in 5 years, right? And so you start to think about things like managing risk in more creative ways. And we'll talk more about Barnbridge later in the chat, I'm sure. But that was kind of one of those things for us. We were just like, oh, this needs to exist, and it doesn't today. And you can kind of extrapolate out where you see the market going and what sorts of solutions will be needed, maybe not today, but tomorrow. So other things like creative, decentralized protocol insurance options, more exotic or flexible derivative financial instruments that, one, feed off of native crypto assets, but 2, can utilize net new technical tools that would never be possible in financial infrastructure from the traditional or legacy world. So I think that's kind of another piece that we look at when we're evaluating, where we want to kind of stake, both capital and our time and energy, and kind of helping these projects in whatever ways we can to realize their vision and serve the broader community.
So just to ask you openly, right now, if we would divide it into several buckets, so one is a financial risk, sometimes it can be over collateralization, or sometimes it can be just technical risk. Some people need a second view on the smart contract. So you need to make sure that the smart contract is not broken, not to repeat the DAO history, which again, right now we don't see a lot of this, but you never know, right? Especially with those new projects. I'm curious, how do you solve this conundrum? Do you hire an outsourced specialist just to take a look at the code, and how do you make sure that they don't appear?
Yeah, so that's definitely point number 4 that we left out is the founder's approach to security, especially when it comes to retail user collateral that's locked in their smart contracts. So one of the first things we do is, hey, how many audits have you had, or how many audits are you planning to have? Who are the auditors that you're using? We have kind of independent auditors that we work with whenever we're going to put our LP funds into a smart contract. Mm-hmm. If it's a newer platform or newer contract or newer pool or liquidity mining incentive, then we'll have independent auditors look at it and make sure that our funds will be safe and there's not an admin key or some other vulnerability in the contract. But a general approach to security and a healthy appetite and budgeting for audits kind of consistently from the founders and protocol side is certainly another piece of due diligence that's an absolute deal breaker. If they're kind of the test and prod Andre approach is amazing. It's he's building at a pace that who knows if it's ever been done before in any industry. Mm-hmm. But obviously there's all sorts of risks that come with that. So, we want to make sure that let's balance both kind of our speed and aggression in going to market with kind of security and maintaining, bringing products into the space that are responsible for kind of the end users.
Got it. And a quick question, what is your typical ticket size? What's your minimum investment?
We've done anything from 50 to 300K. We're, like EJ said earlier, we're stage-agnostic, so we could write $1 million+ check sizes if we saw fit. A lot of the times when we really like to position ourselves early. For Barnbridge, for example, which EJ alluded to, we led their seed round a couple months ago now, and we were involved with that project from before the white paper was even fleshed out. We helped financial modeling their token distribution, modeling out some of the smart yield product. So we like to be really early, and typically when you're involved that early, teams don't need millions and millions of dollars. So it's kind of more responsible for everybody involved and for the VC to not take some egregious cut of the total token supply to write kind of smaller checks at that stage. And then when they go to re-raise and they do a Series A, or so be it, that's when we would step in and write kind of the larger checks.
Got it. And you invest sometimes in tokens, sometimes in equity, right? Because it's also a tricky question. Some companies, they don't have equity, right? So, yeah. Yeah,
Barnbridge was a great example of that. They went completely DAO first. Mm-hmm. So, we literally invested we sent funds from a MetaMask to an Aragon DAO. And now we've been claiming kind of the vested tokens per our vesting schedule via Etherscan. In MetaMask since. So, that was, there was a SAP sort of as a backup, but it was, entirely smart contract, blockchain native from the get-go. And, we prefer that. We love that. That's, we're deep DeFi power users. So that's awesome and really interesting. And, token liquidity schedules and all of that is obviously kind of more enticing to us from an investor perspective, since we don't have to wait for some exit, like a sale or acquisition or whatever years down the line. But we have the flexibility, like EJ mentioned, to buy equity as well, and sit on the board or however we want to structure the investment.
Yeah, the tricky question I want to ask you, especially for someone who's interested in investing in your fund or generally interested in this space, how do you legally make sure that your investment, when you're doing it from MetaMask account, which is still crypto to crypto, so to speak, right? how do you even show it to, because you have fiduciary responsibility to your investors, right? Who are, a lot of times I can imagine they invest US dollars in your fund, right? So how do you show them the NAV, or like, how do you even like, report, and with the growth of the company?
A lot of expensive third-party service providers is the short answer. So, we work with a fund administrator that we're constantly, they're plugged into exchanges. They have Coinbase cracking all the major exchanges. They have direct API feeds in, so they can kind of read our accounts programmatically that way. They can monitor our public Ethereum addresses via Etherscan and kind of see our transaction activity that way. And then we'll provide all the kind of supporting investment documentation around legal agreements and SAPs and token sales, you name it, kind of as additional backup. But I mean, you're alluding to the point that it is extremely complex and difficult to kind of monitor and to engage, to bridge traditional, LP fund structures with kind of the modern investment strategies. Especially when it comes to yield strategies, when we have to account for staking, liquidity provision, lending, all the returns and kind of the net proceeds from those activities and return those to LPs. That's another, that's where we have fund admin, we have audit, we have tax, we have a legal team, and we have custody solutions and banking partners that all charge a pretty penny to help us with all those activities.
And I think one of the beauties of the space at large is that you do have that kind of, at least once the token is launched initially, you have a much faster path to preliminary price discovery. Granted, you see more volatility out of the gates than you do once something's fully diluted, but comparing it to the traditional, world of VC or kind of like private investing, you're often seeing, like we're seeing, Uber, Lyft, DoorDash, like these big kind of fintech companies that have come about and were everyone knew they were valuable, but no one really knew what the market demand was up until the IPO. And then you're seeing, I think DoorDash was up 87% or some number like that, first day of trading. And that obviously just goes to show that all of the private valuations were off base. And so when you have a scenario where you have almost immediate price discovery, or at least the beginnings of it, it does make it easier to kind of quantify what these things might be worth, or at least what the market feels that they're worth. And in the end of the day, that is what price is. So it's certainly more complex, but in some ways it's easier, I guess you could argue as well.
Yeah, for sure. And again, like I was curious to just explain it, because right now digital assets are still under like strong scrutiny. Like we're not like still in a massive adoption stage yet, and it's a maturity stage. And there are a lot of great news. Obviously, we're going to talk about them today as well. Just Ethereum 2.0, like, the 1st of December, like, right now it's 1 week exactly when it happened. So there are a lot of great layer 2 solutions. There are a lot of incredible projects. So, but probably I want to ask you, like, because you're those guys who are ready to take this complex, all the traditional legacy, like, fund structure, and package it for an investor who wants to explore this space and then go and invest in the best possible projects in the industry. So how do you see this space, and how do you explain to your potential investors, why do they even have to care about it?
I think one of the best ways to do that, as kind of simple or tongue in cheek as it might sound, is just to tell them, don't take my word for it. Go try this thing. Like, go try it out. I mean, I know both of us have had so many experiences with friends, family, even parents who, for so long, I was trying to explain to them what this thing was that I was doing in all my spare time at first, and now is my full-time job. And then I pull up, the compound Nabe example that Keegan showed before. And my mom is like, okay, how do I do this? Can you set this up for me? After thinking it's this magical, mythical, like, no idea what's going on with this blockchain thing, this wizardry science. And it's just like, okay, I see the number. That's better than what I get. You're telling me this stable coin thing is just basically a US dollar, then I want to do that. Right. So, I think it's kind of a show and prove situation where the benefits and the usability are just so obvious now that it's really tough not to care. And at the same time, you have these incredibly powerful narratives emerging. You know, the MicroStrategy treasury play, which has attracted a lot of interest and you know, news for the space, I guess. You know,
they bought $50 million more.
Yeah, exactly. And you know, people are kind of talking about that in the space as because the SEC has been resistant to an ETF, a true ETF. I know Grayscale does something similar, but kind of at a bit of a premium. This could be sort of basically a levered kind of call option on Bitcoin, because what they are trying to do now, MicroStrategy, is raise convertible notes, which, you know, the investor can convert to equity at some point down the line to buy more Bitcoin with their treasury. So if that bet's right, you know, they're taking a levered Bitcoin position, and you as the investor have exposure to that just through holding the MicroStrategy share, which is very interesting. If for nothing else than the PR of it all. But what I would also expect is that's really going to put the pressure on the SEC to start to create real legitimate ways to gain ETF type exposure to these assets, because the demand's obviously there. You know, and then you see other narratives like Bitcoin coming on to the Ethereum blockchain. There was kind of that whole debate about one versus the other, when I think both of us really see like these things work together. Like Bitcoin serves its purpose. It's the most mature, the highest market cap, the most well-known, you know, harder money arguably, but Ethereum has so much more possibility in terms of what can be built on it, how the protocols operate alongside one another with the whole concept of money Legos and composability. And when you see this massive migration through Wrap Bitcoin, Ren Bitcoin, TBTC, what that's signaling is that people want to hold Bitcoin, the asset, but they want access to all the tools and the flexibility that DeFi and that Ethereum more broadly allows. So you can kind of you show them the protocols, they see that, you show them the DeFi pulse charts and the exponential growth in, you know, usage and in TVL, total volume locked. And then you kind of explain these narrative things, and the whole, like, you know, monetary policy is at the center of kind of public discourse in a way that at least like post financial crisis, it certainly hasn't been before. And I think everyone's sort of looking at that and saying, you know, how does this make sense that we're just printing these trillions of dollars within a matter of weeks? Like, that's gotta, like, I don't, maybe these people didn't study economics or finance, but take a rocket scientist to understand that is going to have an impact somewhere down the line. So, you know, there's a lot of different kind of factors right now that are very applicable to folks that might not have been exposed to crypto in the past or might have never experimented with it. And now, unlike with 2017, when oftentimes people that aren't familiar with the space compare this DeFi boom to what happened back in 2017. And back to my first point, the difference there was you couldn't go check out Compound, let me go screen share on Constantine's podcast how Synthetix staking works, and like this cool system. There was just a white paper with some researcher that got paid off to sign off on it. And it was just completely like the Fugazi that sort of everyone kind of wrote off crypto because of back in those days. So it's similar right now in terms of like the growth and interest from outside the space, but night and day in terms of what you see once you actually take a look under the hood.
And I just had a couple things, Constantine, you know. So all those points that EJ just mentioned are, you know, 100% valid. Those are all things that directly relate to us here in the States. Hey, you know, earn 500 to 1,000 times more interest on your savings account. Be able to use kind of some of the assets that you have as collateral to borrow against, and, you know, access instant liquidity. Those are all really cool and compelling use cases for us. The second thing that the other angle that we expose potential LPs to, or just our friends and family, is kind of the global total addressable market for financial services that's completely unmet right now. Like everyone's kind of heard the quoted like 22%, or, you know, a couple billion out of the 7-8 billion people on the planet are completely unbanked, or they don't have a bank account. They're keeping, you know, paper and coins at their house. They don't have access to credit or a loan, or investment vehicles to kind of like, you know, gain interest and kind of accumulate wealth in the long term. DeFi enables that for anyone with an internet connection, regardless of who you are in the world. And like, that's, you know, no KYC projects like Synthetix, That's, and Aave, that's a major breakthrough for people and, in places like Venezuela and Haiti and Zimbabwe and Iran, where they, maybe they're censored, maybe their fiat currency is suffering from millions of percent in inflation. We complain here, like EJ was saying, oh, the Fed's printing trillions of dollars. I hope that doesn't cause 5% inflation, because that would be devastating to the American economy and the US dollar. And people in Venezuela are like, 5%. Our currency is inflated 1,000,000%. It's unusable. It's better used as to light a fire and keep the house warm than it is to buy a gallon of milk. So that's the other kind of angle and narrative that is less relevant for us in the States, but is a meaningful use case for blockchain. And we're working with people all over the world, in Nigeria and elsewhere, that this is incredibly fascinating and a major breakthrough that's impacting our lives. So.
Yeah, no, that's all our impressive points, and I'm happy that we're discussing them in details, because, coming back to your few moments that you were talking about before, like, in the previous episode where I had Meltem Demirs, she mentioned, like, all the finance are working on the two major rails, so to speak, like securitization and leverage, right? So in this particular new technology, like which DeFi introduces us, we're seeing those things on steroids, and at the same time, excluding all the intermediaries and providing the risk actually in a more transparent way. Now, when I try to explain it to some of the folks who are, I would say, less technologically savvy, that was tough, because you always have the questions, well, how do you even prove, like, that the risk, diminishes, or like, what's the risk, especially if as to your point, there's no KYC/ML, who's going to be responsible? People can just, like, blow up the projects and run away with their ledger in their hands and buy Lambo. So all those narratives, they still exist. So I'm actually excited to do that. And to another point, just not before we get into the practical rundown on the Barnbridge, and so MicroStrategy actually, with their entire basis portfolio, which the nominal price was about 475 million. If we combine the August purchase of 250 mil, then the September 175, and then the recent one, 50 million, right now their value denominated, if you would denominate it in dollars, it's about 747 million. So they're almost doubled, like in span of less than a few months. So yeah, I guess this is impressive, and that's what people have to understand. If publicly traded companies are now taking a closer look, and now we have less than 30, and I predict that in 2021 we're probably going to have more than 100. That is going to be fun. But again, it's your call. Like, let's explore Barnbridge, which to me is a fascinating project, and you are investors in there. Let's put it this way. All I will say, it's a tokenized risk protocol. Now, the rest you will have to explain in layman terms what it is.
Yeah. Constantine, how about I share my screen and actually run you through it? That's
sure.
The way to do it.
I think that's the perfect way. Yeah.
Okay. Can you guys see here, tokenized risk protocol?
Yep.
Okay, perfect. So this is Barnbridge. So what is Barnbridge? Essentially, it's this super powerful money Lego for risk return tranches. So, this has been something that's been a core financial primitive for the traditional finance industry all the way back to like 1970, when Ginnie Mae first issued mortgage-backed securities. Essentially, it allows you to enter positions with kind of pre-hedged risk. So you can cap your downside and cap your upside if you want to buy Bitcoin, but you don't want it to go to zero because you're an institution that's investing hundreds of millions of dollars in it, like MicroStrategy. Then you can buy kind of a pre-hedged volatility risk position in volatile assets like Bitcoin or Ethereum. So that's one of their products. And the second is the interest rate risk. That's the smart yield product. And that product allows you to build things like fixed income securities, where you have traditional bonds that are yielding, or T-bills that are yielding less than 1% in the traditional finance space. In DeFi, the yields are a lot higher, but they're so volatile. They fluctuate constantly. So how can you package all those DeFi yields together and create kind of junior and senior tranches, the junior being more risky with a higher return potential, and the senior being as risk off as like a fixed 3% interest rate on like DAI or like another US dollar peg stablecoin. So that's what Barnbridge does. And keep in mind those products aren't out yet, but what is out and live now are their token distribution mechanisms, which is these liquidity incentivization pools. So I'm going to go ahead and click Launch App here, and we'll show you the actual Barnbridge app, which is where you can engage in these yield farming strategies. And again, yield farming is essentially just usually putting your tokens to work to earn either more yield or interest in that token that you have as your underlying collateral, or another token that could be like the governance token of the protocol that you're using, like the comp token for Compound, or in Barnbridge's case, the bond token, BOND. So let's talk about the three pools and how they work, kind of what's going on behind the scenes from a smart contract perspective. And then I'll ask EJ to, interrupt me if I'm getting too technical and he wants to dumb any of these kind of concepts down and make them a little more relatable. Then, please go ahead if I get carried away. And then we'll talk about, maybe some of the risks with each of the pools, maybe some of the estimated, return profiles, the yields. This isn't me putting a price prediction out there saying what, a future bond price might be. This is me saying, mathematically, what the return on these investments in terms of an APY is currently today. And that's just a mathematic calculation. So it's much less subjective. So we'll start with pool one. So pool one, which is this USDC, DAI, and SUSD pool, is as simple as it gets when it comes to yield farming. All you have to do as a user is go on Coinbase or your fiat on-ramp of choice and acquire USDC or DAI or SUSD is Synthetix's stablecoin. It's not listed out there on a lot of fiat on-ramps, but you can get it kind of in the DeFi ecosystem on One-Inch Exchange or elsewhere.
Which again, just to note, which is typically 1-to-1, equivalent to dollar.
That's right. Yep. So this is more or less risk-free. Also important to note that these do lose their peg to the dollar. There are situations and events that have happened before. So there is precedent for one of these stablecoins to not equal $1 exactly. The nice thing with USDC is that Coinbase always honors the 1-to-1 ratio. So no matter what, where the peg is on USDC, you can deposit it into your Coinbase account and then redeem exactly the 500 USDC will be worth $500 that you can withdraw to your bank account every time. So that's
do you remember maybe what was the highest deviation from dollar in USDC or any stable coins that we've seen so far, and what was the reason for that?
EJ, maybe correct me here if I'm wrong. We typically don't see it outside of 50 basis points, but it's lost a couple percent at times. Specifically, DAI has had some kind of issues. EJ, do you remember?
Yeah, DAI was, so when we had that issue around kind of the mass liquidations around Black Thursday, that event in mid-March where there was kind of a run on liquidity everywhere. And, you saw stock prices, gold prices, crypto prices all fall. People were kind of scrambling to unwind their leverage positions in their maker vaults. And so DAI was trading at a premium. And I think that was probably, it got up to $1.05, something like that. But when you hear, so like Keegan said, there is that potential for some fluctuation, but they're designed to stay pegged to $1, and through kind of arbitrage, that will always revert. When you hear about anything that is more than that, like recently, a week or two ago, there was an issue on Compound where I don't remember if it was with DAI or USDC, but one of the two spiked up to 130 on Compound, but that wasn't truly what those assets were valued at in the market. The problem there was that Compound relies on a limited Oracle system that looks only at, I believe it's Coinbase and one other centralized provider. And on those exchanges, there was a premium that caused this kind of again, sort of flash liquidation phenomenon. But the real price of those tokens tends to stay kind of within the 5% mark.
Okay. So you cannot lose or gain more than 5%, just to clarify that. Yeah.
Yeah. Sure. If you wait long enough, it's going to revert. Yeah, it's going to, well, you can lose a lot more than that if you're super leveraged. And then, if you're 99% leveraged and it goes from $1 to $1.02, and you're borrowing the stable coin, then you can be in trouble. But the tokens, the stable coins have different designs to maintain that peg, and historically, they've proven pretty effective at doing so.
Okay, let's move on. I just want to make sure people clearly understand what they're getting into. So.
Yeah, that's a great disclaimer. So like we were saying, these are stable coins, so they're pegged to the dollar, and they maintain that peg pretty well for the most part. And all you have to do is you deposit one or more of the stable coins supported here, USDC, DAI, or SUSD, and you earn bond every week. It's liquid, so you can sell it. You can use it in the other pools to kind of accumulate and earn additional yield. If you want to be, hold and go long. And kind of the risk present is primarily just smart contract risk with the smart contract that's set up for this yield farming pool. We've seen kind of the TVL, which is the total value locked, kind of the total value of all deposits in the smart contract exceed $500 million. So we would, EJ and I would consider that more or less sufficiently battle tested. Where we trust it. We also have worked with the Barnbridge team and founders to ensure that there's been a number of audits. So, it's not something that the team just put out. It's, they were very careful and had multiple kind of third-party redundant audits to ensure that user collateral would be as safe as possible in the contract. So that's pool one, deposit stable coins and earn bond every week. Super simple. Pool two is a little more complicated, a little riskier, and with a higher return profile. So pool one's return, fluctuates. It's somewhere 20-25% typically. It's based on
per year, just in case if people are thinking about a monthly.
Yeah, annual percentage yield. APY, I'll notice, is not a great term in crypto because the shelf life on these yields is often much shorter and the volatility is much greater. So, if this pool is only available for 25 weeks, like it's showing here, and you're quoting an annual percentage yield, it's good to benchmark against other yields and other products elsewhere in traditional finance or throughout DeFi. But, this is only going to be available for 25 weeks. So that your ability to actually capture that entire yield, is obviously going to be cut in half. But yes, I'm quoting APYs here. So pool two, like I was saying, is more complicated. So you actually need to take two tokens, your USDC and your bond token. You can just earn bond in pool one, so you don't ever have to buy it, or you can buy it off the open market. And you take those two tokens and you deposit them into Uniswap, which is kind of the premier DEX in the space. It's an AMM. So you take it, by providing liquidity in Uniswap, you get an LP token in return, which represents your kind of share of that pool in Uniswap of all the liquidity. And you take that LP token and you actually deposit that back here in the Barnbridge app. And by taking on the additional risks of smart contract risk in Barnbridge and Uniswap, the risk of impermanent loss in Uniswap versus hodling, the yield in this pool, which is much higher intentionally, based on from the bond team, is designed to kind of offset a lot of those risks and reward them accordingly. And so that yield we've seen as high as 250% APY. So very attractive, but also comes with the volatility risk of the bond token, the smart contract, the impermanent loss, the opportunity cost, which is present everywhere here. Obviously, there's other things you could be doing with your stable coins and Cream, Aave, Wire, and Compound, you name it. So there's all those risks here present, and there's kind of the reward to compensate for it. The third pool here is just bond. It's also very simple. You stake your bond and you earn bond every week. So one strategy we're seeing a lot of people in the community doing is staking stablecoins in pool one, earning bond, and then every week they claim their rewards and they dump them right into pool three, so that way they can accumulate and build additional yield on that bond position. So kind of compound interest situation, and really attractive, and that yields has been north of 100%. So also kind of very attractive when you're comparing it to kind of traditional instruments. And as we know, we're in a severely depressed kind of interest rate environment, which is kind of depressing yields across the traditional finance space.
So to clarify, what is the lockup period between the second and the third product?
All these
pools, yeah.
all the pools, all the rewards are able to be claimed every week, and there's no lockup period at all. So the beautiful thing about these pools is, say I'm yield farming bond in pool 1 for 3 weeks. At the end, I'm like, hey, I'm over it. There's some other cool project that's going on, or I just want to cash out. I want to pull my money out. You're free to pull your collateral out, your stable coins, and kind of the staking rewards that you've earned, the bond rewards that you've earned at any time. So there's absolutely no lockup period when it comes to when you can withdraw your collateral. The period to actually earn rewards is always 1 week.
Wow, that's impressive. And what are the fees? Are there additional fees that I have to pay for, withdrawing money or depositing money?
There's no withdrawal fee on any of these pools. It's just your just the transaction fee, which is the way that you pay for gas to process any transaction on the Ethereum blockchain. Yeah. So you just got to pay for your gas, and other than that, you are good to go. So for real first timers, I think the steps is like, hey, go on a Coinbase, buy some USDC. Transfer that into a MetaMask wallet.
MetaMask, yeah.
You download the Chrome extension MetaMask. At this point, will be responsible for the custody of your private keys. So you'll want to have some, really solid operational security practices. That means email your private keys to yourself. Don't store them on your computer. Don't tell your friends what they are. We like to, write them down on paper and store them in a vault. And we don't even write like the last word of our private key on paper. We memorize it. So we try to be as secure as possible, because, there's no helpline at MetaMask when, if somebody gets your private keys because you are on a shared Zoom call and you type them in or something, that you can, hey, Constantine stole my money. Please make him give it back. They're going to be like, no, thanks. He's that's his now, and there's nothing you can do about it. So when you're custodying private keys, make sure you are absolutely, very, very safe, and you follow kind of the standard operational security measures that the industry kind of recommends. And that's really it. EJ, did I leave anything out on kind of, I'm, like I said, this is a demo address for our own operational security. We're not exposing our address, so I'm not actually going through these steps, but it really is as easy as clicking staking, enabling the token, which will generate a MetaMask transaction. You enable that token, and then you deposit your stable coins into that pool, and you claim your rewards every week. And then you can compound those rewards if you'd like. You can sell them if you'd like. And what
happens if you forget to basically take out your reward? Do they accrue, or they just stay there?
They do accrue, which is great. Which is not the case in all platforms. So Synthetix is going to be our next kind of yield farming demo. Yeah, if we still have time here. And that is not the case with SNX rewards. They do expire weekly. They roll over into the fee pool that everybody can claim in the next week's rewards. So Barnbridge, very kind of retail, newbie user friendly. Not a whole lot of teeth here, or not a whole lot of traps. Not the case in all platforms. So make sure that these kind of yield farming strategies, or the particular mechanics of Barnbridge, certainly do not apply elsewhere. So make sure to always do your own research whenever you're farming on a new platform.
Got it. All right, so we can go to Synthetix, right?
Sure. EJ, was there anything else you wanted to touch on, or are we good?
You want to hop back to that last screen, and I'll just kind of wrap with a quick summary of like why 3 pools, what purpose they serve beyond that kind of technicality. So what we went with, like back in, to compare again to 2017, you had this ICO situation where people were spending lots of money on some future token that may or may not ever exist. And even if it does, may or may not ever, have any utility, be used, serve any governance function. This is a completely different approach, right? So it was important to the Barnbridge team and, to us as investors, that there was a way to distribute this token in a democratic and distributed way. So we needed to get it into the hands of as many people as possible, but specifically the people that actually care to use the token once the protocol goes live, participate in governance, access the smart yield and smart alpha products. So pool 1, very simply, what we're seeing here is you're signaling as a user, A, that you possess the stable coins that will serve as the original collateral types for the true Barnbridge protocol once it goes live. So USDC, DAI, and SUSD. So you're proving that you have proof of collateral is kind of what we called it there. B, you're illustrating that you understand, like you know how to operate MetaMask, you know how to execute the staking function and how to kind of do the basics of yield farming. And C, you care enough about the mission of the project and you see value in it to forego the various other opportunities and the opportunity costs associated with them that exist throughout DeFi and in other kind of yield farm, liquidity mining programs. So as Keegan said, that's really low risk. Just I want to put my collateral up to receive some of this bond token and eventually use it within the protocol. The second pool, what Uniswap does as an AMM, and to clarify, that's automated market maker, which is another cool, novel kind of net new innovation of DeFi that has never existed before. But that's a whole other rabbit hole we won't dive down. But the purpose of Pool 2 is to create liquidity in lieu of sending a bunch of tokens to the centralized exchanges like Binance or Coinbase. You need to create a market for someone that hasn't farmed in Pool 1 or that just wants to buy more bond to be able to do so. So this is a way to incentivize users that have earned bond through Pool 1 to put it into Uniswap so that others can buy, there's liquidity in the market to buy or sell the bond token. And the reward there is set up to incentivize those early liquidity providers for the volatility risk and the impermanent loss risk that they're taking in Uniswap. And then Pool 3 is similar to Pool 1 in that it's designed to kind of like signal an interest in Barnbridge and in the bond token, but you're compounding. You're saying, I don't want to sell it. I want to keep earning it and I want to keep my stablecoins in Pool 1, but I also want to earn more bond by staking in Pool 3. And that obviously, it's a signal for one thing, but it's also positive for the price of the token in that, it's an alternative to just kind of selling to realize a gain from what you've been able to farm in Pool 1.
So really quickly, if I can ask you maybe now that we're going deeper into it, what is the bond price when we're looking at the screen right now? It's $27.38. So what is it like? What's the value behind the bond price?
So the value in the bond price and in kind of like any of these governance specific tokens is that you become kind of a partial owner of this protocol once it goes live. And there are a lot of different ways that can become valuable in the future, but very kind of fundamentally what that means is you have a commensurate say in decisions that are made on, new iterations to the product, new collateral types to accept, where the smart yield product might kind of allocate funds, what different assets the smart alpha product will be able to manage. And you see that, Curve is a good example where the Curve governance token, they had a very different kind of emission schedule and that didn't have the best impact on the Curve token price. But you do kind of see the utility that a governance token can have through Curve or through Compound, again, to say is probably one of the easier ways to see that. If you go in and you can actually look at all the votes that are live to change kind of the mechanics of their lending and borrowing markets. And as a token holder, you have a direct ability to vote on these issues. And once you get to a certain threshold of ownership or stake, you can actually kind of propose them yourself. So the value is derived from the belief in the project's vision and the desire to kind of have a say and a voice in its development moving forward. So kind of like a much more fluid, voting say that you would have through a traditional equity share. Whereas most people that hold common stock in Apple, for example, are never going to go in and actually vote on any of these issues or follow them closely enough. But the point is here that you can, or you can, delegate to someone else to make those choices for you. But the governance tokens really, their value comes from, where you see the project going in the future and your willingness to have a say in that future.
So I know it's a totally different can of worms we're opening right now, but really quickly, maybe how can I vote right now? For example, I hold, let's say, $10,000 worth of bond token, and I want to participate in the governance of the Barnbridge. So how would I impact, and what would it look like?
So Barnbridge is actually the DAO is not live yet, so we're free product for Barnbridge. So There's a launch DAO, which EJ and I, as kind of seed investors, are a part of with the founding team and the developers and the other advisors and investors. So we vote through an Aragon DAO for that situation. So you would log, there's an Aragon website. You log in, you connect your MetaMask wallet, and you can vote commensurately with how many of the Barnbridge DAO tokens that you own. And in our case, it was how much pro rata of the investment in that round that we made compared to the other investors, and the shares allocated to kind of the core team members. So that's kind of how it works. There will be websites, there will be an interface where all the proposals that proposed by anybody in the community with any stake in the platform, and there'll be kind of different thresholds for, one is there kind of quorum for, do we have enough people to actually vote on this measure? And then what's the actual threshold to actually pass the proposal? And that can be for anything like, hey, let's list another collateral type. Let's list another tranche position on, a different yield product or a different platform, or let's list kind of volatility tranches for a different asset. And then the other kind of major price driver for tokens that we see kind of universally across DeFi, again, Barnbridge is pre-product, and governance will be handed over to the community via the DAO. That's not live yet, but for things like Synthetix, which we'll jump into right now, that token actually represents a real claim on the cash flows of the protocol. So in that case, it's like a dividend where you can value the token via traditional valuation methods like discounted cash flow, and look at what claim on the cash flow does the token have in terms of staking rewards or you name it, and then kind of as usage increases exponentially over the coming years and people find the product useful. How's that fee pool, which we like to look at Token Terminal, which I have open here, and it shows kind of the market cap, the price, the revenue or the fees generated by the protocol, and you can use that to kind of run PE ratios or do discounted cash flows and say, hey, if this protocol is actually generating this much cash flow or this much revenue, how much do I think it's going to be worth in 2 years with 5x more usage or whatever kind of drivers you want to use in your financial model there. That's the other kind of big element and token price driver that we look at. Again, doesn't apply to Barnbridge yet because the products aren't live yet, but it applies to a lot of other products and a lot of tokens in the ecosystem, Synthetix specifically, which we'll jump into next. Does that make sense?
Yeah, that's super helpful. And again, the token terminal that you showed, I guess it's almost like a future Yahoo Finance element of it, which is very important for bigger institutions to just take a look at how can I provision what's going to be with this particular protocol in the future.
Right. Yeah, like EJ was saying, back in 2017, these were half-baked white papers and PowerPoint decks that we were investing in with no product, certainly no cost-flowing product. So it was more like, hey, I think it's going to be worth $50. And that was kind of the most sophisticated valuation methodology that we had at our disposal at the time.
Yeah.
Now we can use all the traditional valuation methods because these are cash flowing digital companies, and the tokens more or less in some cases represent kind of digital securities or equities. So much happier and much safer investing these days than it was in kind of the 2017 ICO era. So with that said, if you're okay with it, Constantine, I know we're kind of already running over time here, but would you want to?
It's fine. Let's do it. I think it's worth it. It's such a fascinating topic, so we should go all the way.
Okay, cool. So let's first talk about kind of what Synthetix is. So for one, Synthetix is kind of two pieces. There's an exchange, which was recently rebranded to Quenta.io, and then there's kind of the Minter staking side of Synthetix, and that is a mechanism to provide collateral or liquidity for the exchange. But at a high level, Synthetix is this insanely cool decentralized derivatives exchange that enables traders from anywhere in the world to trade virtually any asset in the world with infinite liquidity and zero slippage. This is made possible by kind of Chainlink oracles that power what we call synths. So synths are just synthetic representation of any asset. And, I'm clicking on this drop down right now to show you any assets from crypto like ETH, Bitcoin, a DeFi index, which tracks, a number of, if you want to gain exposure to kind of DeFi in general, and, you don't know which ones to pick or how much allocation or weighting to put to those individual tokens in your portfolio, You can just go long or short for that matter on DeFi or any of the other tokens here. Forex, so synthetic dollars, euros, Japanese yen, pounds, you name it. Equities, which right now are just kind of, London's FTSE 100 and Tokyo's Nikkei 225. So a couple of indices, but with planned support for American equities like Tesla, Apple, Amazon, which you'll be able to trade long, short, futures, options with leverage, you name it. Really any financial instrument or any other money Lego that's present in the space can be applied to synths, which are kind of individual tokens. And then the fourth asset class that's available on Quenta, formerly Synthetix, is commodities like gold, silver, perpetual oil futures, etc. So, like I mentioned, why we're so bullish on the exchange and therefore the token, which has a claim on the cash flows generated by the exchange, is all these future use cases for any asset in the world that has a chain link price feed can trade on this exchange with no KYC, with infinite liquidity, zero slippage, in any financial kind of instrument that you would like, futures, options, you name it. So that's Synthetix in a nutshell. That's why clearly you can see I'm extremely excited about it. And that's the exchange portion. So that's kind of the first half, and now we'll talk about the back end. What does the back end look like? How are all these, who's the casino, who's the house that allows for all these gambling on different assets? And the house or the casino is really this minter piece right here. So again, this is a fresh wallet with no assets in it for the purposes of the demo, but I'll walk you through how to actually get started in staking SNX, which staked SNX, the value of all the SNX staked, serves as collateral or liquidity for the exchange that we just showed. So the first thing you're going to want to do is buy SNX. You need the SNX token. And you can get that on 1inch. So if you want to buy USDC or ETH on Coinbase, you want to send that to a MetaMask wallet that you own and you have kind of secure ownership of the private keys. You can go on 1inch, which is this really cool decentralized exchange aggregator that programmatically routes your trades to find you the best price, to find you the lowest slippage, to try to save you on gas across kind of all the different exchanges that it's plugged into. So Uniswap, Dodo, SushiSwap, Balancer, etc. So you go on here, you trade your USDC for SNX. Keep in mind that this is a real trade, unlike Barnbridge when you're just kind of proving collateral, putting your stablecoins up, earning bond, and then you can withdraw the stablecoins at the end. This is a real trade. So you're actually exchanging your stablecoins for SNX or your Ethereum for SNX. So this is no free lunch here. So once you have your SNX, you hop over to minter.synthetix.io and you'll have your SNX in the wallet that's connected here. You'll go ahead and you'll click this mint button. This will give you the option to either max it out or be a little more conservative if you want to have, if you want to save some SNX not staked, that's fully liquid that you can sell whenever you want or whatever. And you press the mint now button. What happens when, behind the scenes in the smart contract, when you press this mint now button is you're being issued SUSD, and that SUSD that you're issued becomes a debt that you will then owe back to the system whenever you want to unlock the SNX, enable, in order for me to transfer to EJ, to sell it on 1inch, to do whatever I want with it. I don't have access to that SNX that I staked until I pay back my debt. And then the ratio between the total value that you have staked and the debt that you have is called your collateralization ratio. So that's just, if you look at kind of this little table down here, you'll see that you'll have, X number of SNX that are worth $4.91 as of this recording today. That'll give you kind of a total value of all the SNX. And then you'll have a debt down here, which is the total number of SUSD that you've minted against your staked SNX. And in order to claim staking rewards, you'll have to maintain a 600% collateralization ratio. For example, like $600 in staked SNX for every $100 of debt that you have. And if you do that, what you get in return for staking SNX, which is providing collateral and liquidity to the exchange and enabling that awesome product that we just went through, is you get SNX staking rewards and you get SUSD staking rewards. So you'll go at the end of the week, you'll go in here on Wednesday mornings, Pacific, and you'll be able to claim your SUSD and your SNX. your SUSD, where these rewards are coming from, these are actually the fees that are generated by that exchange. So everybody who's trading on Quinta is paying a fee in order to trade. So if I want to go long on gold or short on DeFi or Ripple or whatever, I have to pay a fee in order to make that trade. And those fees are split up pro rata based on all the stakers on SNX. The second component of that reward is your actual SNX rewards. And that comes from SNX's inflationary monetary policy. So SNX has very transparently and deliberately installed a inflationary monetary policy where they're printing more SNX in order to incentivize or bootstrap liquidity for the exchange. That return has been, close to a year ago when EJ and I were first got involved in staking SNX. That return was like 90+%. It was crazy, and it's on this exponential decay. So today it's, I'll go over to SNX tools, which are built by our good friends at Framework Ventures, and SNX stats, dashboard.synthetix.io. These are two really popular tools for kind of understanding all the various metrics involved with staking SNX. And you can kind of see what the annual yields in various pools are. So in just staking SNX in general, this is kind of showing the total market cap, the SNX volume, the price, the average C ratio. Here's your current SNX staking APY, it's about 24%. And you can get a sense of, hey, what's my opportunity cost? How much am I making in staking rewards? And then that's your first level. So I think I'll pause there and let you react.
Yeah. So let me, because this is fascinating. I think it's mind blowing, on the one hand, but I also can assume it might be a little bit more complicated for people who are the first time, engaging with this content, because there's a lot of moves. There's a lot of things, how to evaluate the risk and the opportunity, as you've mentioned. So can you come back to the other screen when there is the SNX tools, the one that is this one. Yeah. So right now, let's go from coming from a greed factor, right? So right now, the current SNX staking APY is about 24%, right? If we go back to with the logic, you don't have to go on a screen, but just we remember that the Barnbridge, the pool number one actually provides you a similar return, which is, again, you're not staking more volatile asset. It's a stable coin, which is as a USDC, and the risk are, I would say, lower than this particular context, right? So can you explain the logic right now for someone who's trying to get in this particular moment of time? It can change obviously in a month, right? So how would you evaluate the opportunity between those two options?
Sure. A couple factors. Maybe I'll let EJ chime in since I've been talking forever, but one of the points that EJ mentioned earlier is kind of the fully diluted value and how that has an effect on token price. And then the second thing I'd say is these are just two different use cases. So really it's hey, how much usage do you think these use cases are going to generate? How many fees do you think the protocol will generate based on that usage? And then which token will be, have a higher future price, and which token do I want to try to accumulate now? So one may have a higher yield now than the other, but those yields are denominated in bond and SNX. So if the SNX token appreciates much more than bond, then the lower yield, your net, you're coming out with a better end result and better net return. So that's kind of the high level that I'll leave it at, and then I'll let EJ jump in if he has anything.
Yeah, so I think, for looking specifically at pool one for bond, which I think is what you were asking about, Konstantin, it's a very simple mathematical equation. You have a certain amount, call it $10,000 worth of USDC that you're staking in pool one. You can see right on the Barnbridge UI down on the my pool balance piece what kind of proportion of that pool your collateral makes up, and then you get that percentage of the 32,000 weekly bond. So the only variables are how much collateral you've put in, and there's also a time function. So if you deposit midway through the week, it's pro rata based on how long you were staking. But assuming you were in at the beginning of the week, your percentage, and then what happens to the bond token price once you receive it. Obviously, if we're quoting a certain APY, but then bond gets cut in half or doubles overnight, that's changed what your true realized yield has been. But that's very simple. Whereas in the Synthetix case, you're staking, the token is much more mature. So, that can be looked at in a couple of ways. One, explosive growth might be not as likely, but at the same time, Synthetix is set to release a ton of exciting products in the coming months. So maybe not as applicable here, but you also have kind of the SUSD component of it. And the idea there for folks that are familiar with Bitcoin, but maybe not DeFi as much, the sort of the seesaw counterbalance of the reward in Synthetix, in SNX token, and the reward in SUSD. The concept being that as more of these novel products come online to Synthetix Exchange, and there's more users that are willing to trade them and pay that 30 basis point fee, the fees generated by the exchange are going to be higher. So while the SNX emission is kind of on a diminishing schedule and will eventually end, just like Bitcoin, there will eventually be no more Bitcoin mining rewards denominated in Bitcoin once we hit the 21 million. The idea on the Bitcoin side is that the network fees will be sufficient at that point to still incentivize miners. So in the Synthetix ecosystem, the idea is like as the SNX rewards are kind of winding down, the SUSD component is coming up, and it's still going to make it lucrative for you to, as Keegan said before, act as one of these many decentralized players forming the house of the casino, if you will.
Yeah, because Bitcoin economy is deflationary, right? That's why it's kind of easier to predict, like, if the adoption, it becomes bigger and the demand is growing and it's something like scarce asset, then the price goes automatically. Here, it's a little bit more complex because you're issuing additional, again, ironically, I have to use the word synthetic asset, SUSD, like on top of what you already have with SNX. So you have to think with, I would say more complex logic here. That's the reason why I'm asking. So let's assume like bullish case. Again, we can speculate a little bit. This is not a promotion. I'm not an investor in SNX or any of the constituent exchanges. So I can speculate with facts. So imagine it will be listed in one of the top exchanges, whatever that may be, Gemini, Coinbase, doesn't matter, right? And the price doubles, just hypothetically, right? So the people who already staked on SNX, the short-term contract, like whatever it may be, like it's a week, and then they have additional SUSD value. So what's going to happen then? So nothing, and the price will just grow, or what's the outcomes?
Well, so as a staker, what that means is, like Keegan showed before, your collateralization ratio is based on the value of the Synthetix that you have staked and the value of the debt that you've minted against it. So, all other things equal, say there's no more trading activity kind of in the synthetic pool, like against you, if you will, your collateralization ratio is going to go up if the price doubles. So you can now mint more USD. SUSD, you can increase your stake in the staked pool and earn a higher proportion of rewards going forward. But you can, ultimately issue more SUSD debt against your collateral that can then be traded by yourself or against by others within the exchange, which of course, has a positive effect on how much trading activity is going on in the exchange and how many fees are being generated, and that full cycle kind of proliferates.
And that's actually a really good segue into kind of the next level of yield farming with Synthetix. This is just layer one in the Minter app. What happens with, like EJ, when you said, like EJ just said, if your SNX appreciates, you're able to mint more SUSD. And SUSD is a token that has all sorts of interesting and sophisticated yield farming strategies. Additionally, as your second layer, so you're yield farming with an SNX, and you're getting SNX and SUSD. But all that debt that you've issued against your stake collateral, that SUSD, you can go out and earn yield elsewhere in the ecosystem as well. And I can really quickly run you through a couple of those options because it kind of demonstrates.
Sure, let's do it.
And it demonstrates how amazing Synthetix has been from the get-go and incentivize, one, kind of giving birth to yield farming and kind of the standards that we know today. And two, incentivizing directly composability with other protocols. And like EJ said, making it attractive for you as an SUSD holder to go and provide liquidity elsewhere. So that way, kind of the entire DeFi ecosystem has SUSD proliferated throughout. So one thing you can do, and I'll kind of just show you when I said Synthetix actually incentivizes you to provide liquidity elsewhere, are this LP reward section up here in the top right. you can see all the different incentive programs that Synthetix is running or has run previously. So between Curve, between Uniswap, between Balancer, and then actually owning some of these synths and staking those, Synthetix has paid out, and in the case of Curve, it's 8,000 SNX per week for anybody who's taking their SUSD and they're providing it as liquidity on Curve for people to trade stablecoins against it. So that's this next layer of what you can actually do. And I'll kind of show you really quickly. If you wanted to take advantage of this Curve Pool SUSD reward, you could simply hop over to Curve, go in this top left menu and select SUSD. Make sure that you have SUSD selected, or else it won't show you kind of the right option. Go into the deposit screen, and then max out your SUSD or put however much SUSD you'd like to stake. And then you can hit deposit, which will now earn you Curve fees, or you can hit deposit and stake, which is kind of a two-step transaction. And now you'll be staking in Curve, and you'll be earning 3 assets now. You'll be earning SNX and SUSD, just like you were previously. And you're also earning CRV, which is Curve's native governance token. So now this entire strategy, the 2 levels of it is, one, I'm earning SNX and SUSD. Now I've taken that SUSD that I minted, I've deposited it in Curve, and I'm earning trading fees for all the traders that use my liquidity to trade in Curve. And I'm also earning the CRV, the Curve governance token. So this is just like compounding yields, layers and layers, getting super technical, but it's demonstrating the larger point that the composability of this space and kind of the total yield that's possible, that's leveraging smart contracts and blockchain is just, it's an exponential orders of magnitude improvement or game changer that we've seen in traditional assets like traditional equities. So,
are there any other levels after
there
Curve?
There's always other levels, Constantine. That's the thing. There's always other levels in DeFi.
Always do a red pill.
So, let's talk about Wyre real quick. So Wyre at a high level is a platform that has been, they've been building out all sorts, this menu a few months ago only had 3 or 4 options. Now they're building out products like you name it. This is Andre, the core developer that I mentioned earlier. He's a genius and ships products faster than anybody kind of in history probably. But anyways, if you wanted to just take your SUSD and rather than put it on Curve, you wanted to deposit it into a earn vehicle on Wyre, you can go ahead and just click SUSD here in the Wyre and then max out, put whatever percentage you'd like. And what this does, right now, SUSD isn't the greatest example because it's really only available on for depositing on Aave. But say you had something like DAI, which is available on Maker and Compound on Aave and also all sorts of places. What this does is it programmatically allocates your DAI to whatever money market in the space has the highest yield at that time. So you are constantly maximizing your yield. The analogy that I'll use here is like, say I have some cash sitting in a savings account at Chase, but Bank of America comes out and they do, hey, we're going to offer twice as much interest as Chase. And now, I have to go to Chase or go online. I have to pull out. I have to create an account at Bank of America. I got to, withdraw and deposit and move it. I got to do all those steps to capture the delta, the increase in yield available at Bank of America.
What do you do essentially? They're putting like Bank of America, let's say Chase and other banks to compete for your yield.
That's right. Compete for your collateral, compete for your liquidity because they can use that liquidity to lend out.
Yeah.
In a completely seamless way that you don't even have to do anything as the user. And from a market perspective, it's important to remember that although this kind of seems like a cat and mouse game in a sense, there's a reason that there is yield one place higher than the next. It's because that's better. There's more use for that capital there. There's more demand for that capital there. So what you're achieving here at a large scale is seamless and immediate capital efficiency, which is something that we just don't see in the traditional world because there is no composability and interoperability like between the savings account, like Keegan said, and you have the gating items of needing to go through the registration process, having accounts different places, background checks, all those things. So I mean, it's just night and day, kind of the the experience for the user, but also the efficiency of the system at large.
Yeah, this is impressive because it's also transparent, like, and as opposed to traditional finance, you would never know where your money is going to be lent out like 10 times, after you just deposit it to the bank. Like here, you at least like it sounds complex, but at the same time, I just want to encourage people who are listening to the podcast version to take a look at the YouTube, and people who are watching the YouTube right now and they're looking at it and they're like, oh my God, I'm probably like, it's not an advice, but like I'm probably selling my house and like compounding everything. Like, because, with this strategies, like, I mean, they're limited. Also, another thing I just want to mention, because we're all excited here. We're talking about like those impressive like opportunities and technologies, but they're probably in time, probably in 1-2 years, they're going to decrease, as the market growth. And so again, not advertising it, but it's a very good time just to take a look and to learn more about it. Now is the time. But coming back to the practical aspect of it, so now you're putting your curve into urine finance, right? Sorry, I name it urine. I cannot say why urine. It's just hard for me. So this is another layer, right? So, and I'm sure you can figure out some other layers. The question is, how do you even trace it? Like, you probably have to have, as an individual investor, you guys are equipped. You probably have some certain systems, in place, and institutional money, it's a different story. How would you advise someone who's doing it 3 to 4 layers to even track all those things?
You are just the segue master, Constantine. So the next tab here is Zapper. And so one last thing before we leave the wire. And so all those steps that I just mentioned, those are all programmatic within the smart contract. So you as a end user, you don't have to even know what's going on, where your money is at any time. And frankly, you won't. All you do is you deposit one time into a Y vault or into an earn account, and Wiren takes care of all those steps. So those aren't steps that you're doing as a user. I'm kind of explaining what's happening behind the scenes to make it make a little more sense. Like, how is this yield possible? In the case of like Y vaults, it's even more sophisticated than the earn accounts, where now the Y vault is like borrowing against your collateral. Harvesting governance tokens, using those governance tokens to market buy the asset that you have, depositing that asset back. So it's like pushing the price up and earning more of the actual number of the tokens you have of that asset. So it's doing crazy things. But the fact of the matter is, you don't even have to do any of those steps or even be aware of what they are if you don't want to be. We recommend everybody kind of do that research and be aware of what's happening, because it makes you appreciate it, makes you understand the risks that much more. But yeah, it's really, quite easier than I'm making it sound, or, maybe I could have done a better job saying, hey, don't worry about all those things. That's all kind of behind the scenes. So what your question was, hey, how do I even keep track of all my stuff? Now I have stuff in Synthetix and in Minter and Curve, and I have LP tokens that are now elsewhere in Wiren, and like 4 levels of staking and yield farming. Like, how the heck am I going to unwind all these positions? What if I forget? No one's, MetaMask isn't going to call you and say, hey, we'd just like to remind you about your Y vault position. It's the end of the year, and we want to make sure you don't forget about it. That's never going to happen. But who will take care of it for you is Zapper. So this is going to show a whole lot of goose egg because I don't have any assets in this account. But if you did, what Zapper is kind of this automated dashboard, and it's more than that. It allows you to it has what are called zaps that allow you to invest and actually deposit your liquidity and maximize your yield, and then unstake and unwind those positions as you please. And it kind of keeps track of all of your assets across everything that across all the platforms. Any asset that's held in this wallet will be listed and shown, and kind of the various layers of yield farming like we're talking about can be either wound up or unwound directly in this one place. So you don't even have to go to all the other websites. You can really kind of operate out of here from like a portfolio management, asset management, once you've kind of built those positions. So it'll show you kind of your account overview, how much your total assets are worth, what your net worth is. So say you borrow against, say you have 10 grand and you borrow $1,000 against your 10 grand, it'll show your net worth at 9 grand. It'll show the allocations between platforms and strategies. So if you have yield farming, if you have debt, if you have liquidity provision, the different strategies. It'll show where all those funds are parked, and which platforms they're parked on between Synthetix and Balancer and Wiren and Aave and everything else. And then the really cool thing that I love is it actually shows you some of the pools and yield farming strategies that are out there, how many fees that we're earning. So this is kind of similar to that token terminal that we showed you earlier. It shows the revenue by platform, but this brings it down to an actual pool level. So the specific 3-pool curve. So if you remember on curve, we had to like select which pool we wanted. If you go to this, this is showing this 3-pool curve right here. Zapper's saying, hey, this 3-pool curve has generated $9,000 in fees over the last 24 hours. If you want to add liquidity there, you can get a pro rata share of those fees. So it's an asset. It's like a portfolio overview, and it shows where all your stuff is, where the assets are parked, what they're doing, the allocation between different strategies. And then 2, it's like, hey, you have some liquidity that's not even you're taking full advantage of. You can actually stake that token, or you can add that token as liquidity in this pool and earn additional rewards. So, and then it keeps track of all your transactions. And there's kind of other cool, it has like a kind of a basic swap functionality, and they constantly ship. So every time a new platform comes out, they integrate, like they integrated with Barnbridge. I think, EJ, what was it, less than a week or something? So if you own USDC, bond, the Barnbridge pools can be one of these options that it shows you. Or if you own the bond token and it's not staked in pool 3, it'll show you, hey, you can actually put that in pool 3 and earn even more bond. So I think that's probably the end of the demo. I think we've covered a lot of, complex different platforms. We demonstrated kind of the different risk and returns associated with different strategies, how to kind of aggregate them all into one dashboard and keep track of everything. And then just, first and foremost, the incredible composability and the capability of generating just insane returns in the DeFi space. So unless you have anything else to add to that demo, I think that wraps it up on my end.
Yeah, I think we've probably given enough now for to confuse themselves, learn some things, get their hands dirty, and there's tons of resources out there. I think Barnbridge has done a really good job of kind of publishing Medium articles at every step of the way about what the different pools do, how you interact with them, and same goes for all these protocols. I mean, Synthetix has a fantastic blog where they're publishing updates on every release and different incentive programs. So, I mean, the information's out there. You just got to know to look for it, and you got to be willing to kind of put in the legwork and take the time to figure out the space for yourself. But there's, as Constantine said, the opportunity is incredibly ripe, and quite frankly, it's just a lot of fun once you get the hang of it.
Yeah. I mean, by the way, you're showing right now that DeFi Pulse is one of the other platforms that I recommend just to use. I use it all the day, just to watch the portfolio and to see what's the movements, So I think you did an amazing job. For someone who's the first time watching it, that's going to be enough of food for thought, and probably hundreds of hours of more to research, but at the same time, it's not that complex. So I really encourage people to just take a look and whatever, just to even try with some pocket change, whatever you're gonna happy to lose, like $100, just to try it on, to see that this is transparent, equivalent of Swiss bank, that allows you to earn, to be a real stakeholder, not a depositor, not a client of a bank, but literally a shareholder and a revenue share, participant in a modern, decentralized, transparent bank, which is impressive by itself. And I think we don't know, probably we're gonna have some other experiments of that sort, and I really hope that the user experience will improve. This is my personal message to Curve guys. Literally, it's a Game Boy design. I'm sorry, I don't enjoy
or Fidelity. Yeah, we should have probably shown Aave. There's some better interfaces. So Curve.
Yeah, Aave is much better. But then next episode, I'm happy to go a rundown on Aave. By the way, I'm gonna invite probably Stani as a second.
Oh, great.
So I'm excited about it. So. No, guys, I mean, I really appreciate your time. I think what you did is just impressive. And I really wish, that your vision and your investment thesis will bring more people, not only money, which, again, this is the purpose of any investment vehicle, but also what's more important, a new paradigm shift. a new understanding that the world is changing, that it is becoming more transparent, it's becoming more global, and it doesn't matter that whether you are in the United States and you're in the West Coast, I'm in the East Coast. So yeah, it's not like we're not fancy like anymore. Like, you can be anywhere in the world and participate in this new technology. The last thing I want to end up like is more on a philosophical level. It's my Eastern European blood in me, like, so I'm going to ask you both, what's the meaning of life to you guys?
Wow. EJ, you got to take that one first, man. I need a second.
Yeah, I specifically don't notify people like about this. I wanted to be very genuine. Yeah.
Yeah, for me, like, a big thing is just restoring everyone's faith in humanity and making sure that we have a healthy, happy, prosperous world to pass on to the next generation. And then that in essence is just preserving life itself. So preserving the ability for life to go on. And I think that that's what evolution does biologically, and that's what we should kind of be tasked with philosophically. So
beautiful. EJ?
Yeah, no, I mean, like that kind of hits the nail on the head. But I always kind of look at it, have friends, family, different religious backgrounds, different outlooks on broader philosophy. I always just kind of see it as, I guess maybe you'd call it karma, but trying to leave like every person that you interact with, like, do more good than harm, bring more happiness than sadness or pain. And then kind of at a more like systemic or global level, trying to, as a generation, create a more fair and a more accessible and democratized kind of infrastructure to allow other people to do the same, to take away kind of some of the artificial ceilings and the chains that hold others down from being able to realize their own, hopes, dreams, freedoms, whether that means financial or otherwise. And, I think for both of us, that's really like, you can get pretty fanatical about it, but I truly do believe that what we're working on here and what everyone in the space is working on here serves those goals. Finance, DeFi kind of proves to be the first use case of that, because people worry about like money is kind of Maslow's hierarchy of needs sort of deal, like one of the things people need to worry about first. But if you can give people the ability to have financial freedom and the wherewithal to not have to worry about money, it really frees you up to think about what matters to you and pursue kind of like the mark you want to leave on the world at a more meta level, I guess.
So I hope we will win more hearts and minds, of people who just watch this interview. And I really appreciate your time, guys. I think you both are amazing. I encourage people to visit your website. I think, by the way, it's a pretty cool design, guys. So I'm going to post a link in the description. So yeah, thank you so much. And I hope, we're going to chat again.
It's been a pleasure, Constantine. Thank you.
Yeah, thanks, Constantine. Looking forward to it. Have a good one.
Thank you so much.